Hey folks, welcome to a brand new episode of Smart Money. Since it was Women's Day this week, we decided to go full throttle into giving you some advice on how to approach your finances. If you are a woman, if you haven't started investing yet. In fact, this is a topic very close to our heart. We have a campaign ongoing which is Future Female Forward, where we're trying to embolden and enable women to take all their decisions, whether it is with respect to finance, health, gender parity, and a lot of issues that need to be addressed. Our expert today is Mrin Agarwal, who is a financial educator and director of Finsafe India. She's been doing a lot of work to help women get, financially literate and take charge of their money. Well, Mrin, thanks a lot for joining in. Now, it's a well-known fact that women tend to go in for safer investments, right? For generations now, our mothers, grandmothers would always invest either in gold or in fixed deposits. How do you sort of look at that changing over the next decade or so?
So good afternoon, Sonia, and thank you for having me here today. I think for the longest of time, women have always been associated with safe investments. And I think it's really the fear of losses and wanting to have more financial security that gets them, to invest in gold. But I think the good news is that now we are seeing more women interested in investing into equities. Even in all of my sessions, I'm seeing more women coming, more women asking questions about what sort of equities should they look at, and really, looking at financial independence a little bit more strongly as well.
Okay. So as I said, right, it's very typical for women to invest not just in fixed deposits, but also in gold, in insurance schemes where they've lost a lot of money as well. We just want to clarify, are these good investments or not?
Well, see, whenever you're investing in any instrument, you need to see whether it's really beating inflation, because if it's not beating inflation, then your money is really not growing. So when you look at, I'm completely against investment-linked insurance schemes, of course, because they just do not beat inflation. I think fixed deposits and gold to an extent are okay, and for specific reasons. So, for example, fixed deposits always work well for the short term, 1 to 2 years. And currently, of course, you've got some great deposit rates that are available from various banks. Of course, gold also has its own utility to an extent. The point is that, again, these are not investments that you should go overboard with and form a core of your portfolio.
Okay, I take your point about FDs and insurance schemes. I mean, there is a lot of money to be lost there. But gold has done really well, right, Mrin? If you look at the last 1 to 2 years, gold has outperformed equities. In fact, in every recession in the last 7 out of 8 recessions, gold has done much better than equities. So why then do you say that it's not a high-yielding instrument? And from here on, what is your advice on gold?
Well, when you look at the long-term performance of gold, I think in the last 40 years, for example, if you see the returns in India, I think it's somewhere in the range of about 8.85%. Whereas if you look at a Nifty return, it's in the range of about, I think, 15%, with inflation being about 7.6%. So I think, those numbers tell for themselves. And a lot of the gold performance that you see in India is also due to rupee depreciation. So, yes, while it has beaten inflation, and while it certainly has a place in people's portfolios, the whole point is that equities have far beaten inflation much more than what gold has, and which is why you do need to have more equities in your portfolio.
Okay, just one more question on gold since we're on that topic, right? And then we'll move on to equities. If someone wants to buy gold now, and we've done a couple of videos on this as well, the most prudent way to get into gold would be perhaps sovereign gold bonds, because you don't have the issue of safety, security of looking after physical gold. There's no making charges as well. But do you agree that sovereign gold bonds are the way to go, or do you think even gold ETFs is another way to explore? What's the best way to approach gold now?
Well, I think I would say 3 things on gold. One is limit the exposure to gold to 15% of your portfolio, which in any case, I think most Indians have. The second thing is that buy only as much physical gold as you think that you need for your personal use. And if you're looking at gold as an investment, why I like SGB is for all the reasons that you mentioned. It's zero cost. It gives you tax-free returns at the end of 8 years. And of course, it's sovereign issued as well. So that's what works in its favor. But the issue is that there is that 8-year lock-in, and of course, after 5 years, you can go and sell it. I think if you want a little bit shorter time frame, and if you want more liquidity, then you can certainly look at gold ETF. But overall, when you look at the returns, I think SGB has given the best returns in all of these three options of gold.
Okay. Since you are not in favor of investment-linked insurance schemes, right? You started off by saying that don't invest in insurance schemes. You are all set to lose money if you do that. What are the good alternatives? Tell us, where should women put their money if they're just beginners?
So I think first, one scheme that I really like, and I think people should take advantage of it. In fact, I've been getting a lot of queries on some of the capital guaranteed plans that are there. And I think a better scheme that exists compared to the capital guaranteed plans from insurance companies is a target maturity fund. Because when you look at a target maturity fund, so let's first talk about what it is. This is firstly a passive debt fund, which basically invests in bonds linked to a particular index. Now, this index typically consists of government securities, state development loans, and it also consists of typically AAA rated PSU bonds, right? So the fund is basically replicating this particular index. And again, the biggest advantage of this scheme is that it's open-ended, right? So compared to fixed maturity plans, which are close-ended, while this scheme has a maturity date, it is open-ended, which means that you can exit when you want to, right? Now, the advantage over here is that you're getting a very good quality portfolio. You're also getting it for a shorter period of time. So, for example, you have target maturity funds available right from 3 to 4 years onwards, going to about, let's say, 10 to 12 years, right? So you have a broad range of timeframes that are also available. And the way the target maturity fund works is that it basically buys these bonds and holds it to maturity. So this allows for a fair bit of returns visibility for the investor. Now, when I look at the returns right now, on a pre-tax basis, I think we are looking somewhere in the range of about 7.5 to 7.75% on most of these bonds, which I think is a very good return, because if you invest before March 31st, you're also going to get the benefit of that additional indexation. And hence, a very, very tax efficient product. I think on a post-tax basis, you're looking at anywhere between 6.5 to 7.1% post-tax sort of returns, of course, depending on the maturity of the bond. And I think that's a great return to basically tie into, as compared to getting into a scheme, capital guaranteed scheme, which is much, much more expensive. So I think the first one for people who really want to play it very safe and who do not want to take risks can look at target maturity funds. For others who can take some amount of risk, and remember that when you invest in investment-linked insurance, they also invest into equities, right? It's not that they only invest into bonds. So if you can take some risk, another product which I think works very well for any investor is a balanced advantage fund, which basically invests into equities and bonds and keeps rebalancing the allocation based on various market-linked parameters. And most of them have their own in-house models that they use to carry out the rebalancing. So the good thing that I like about balanced advantage funds is you're getting exposure to equities. So you're having the asset allocation being done for you, and you're getting rebalancing happening at regular intervals, which means that, when the markets are high, typically they would be rebalancing in favor of bonds and vice versa. So this is a good, both of these are good products to invest and, just remain invested for the long term without really having to do a lot of monitoring or, without having to keep checking these products on a regular basis. And that's why I like these two products a lot more than locking into any long-term insurance, because these are more liquid, can be exited at any point in time, and very, very transparent.
Okay, so that's some really sane advice coming through. Ladies, if you're listening, there are two products that Mrin has spoken about. Target maturity funds on the debt side, which will give you a safe and secure return around about 6 to 7% post-tax. And then you have the balanced advantage fund, which is also, something that invests in stocks and equities as well. So you have a sort of a balanced portfolio. Mrin, it's interesting that you talked about balanced advantage funds. Generally, equity is a product product that women are hesitant to invest into. If a woman wants to invest straight up into equities, right, what should her strategy be? How much should she invest in balance advantage funds? Any other funds that you would suggest?
Okay, so first and foremost, I don't recommend investment into stocks directly. The reason being, or even stock baskets for that matter, the reason being that it's very difficult for individuals and lay investors to really evaluate stocks. I mean, there's so many stocks. How do you figure out what to buy? How long to hold it to? Regulate your exposure to stocks and sectors, right? And of course, what do you do in volatile times? What happens if the prices fall? Do you hold on? Do you exit? Do you buy more, right? And of course, the capital allocation that is required for stocks is much higher. So I don't recommend investing in stocks at all, or stock baskets for that matter. I basically recommend sticking on to mutual funds simply because these are professionally managed. You have a lot of low cost options available, which are very, very tax efficient. Now, in terms of what are the funds, right? So I would certainly say that if you want to do a pure equity fund, the easiest thing to do, and if you believe in the India story, is to look at the Nifty 50 index fund. It's the easiest thing to invest into. There are many different funds that are available. I mean, there's a fund available from practically every fund house in the Nifty 50 category. So look at investing into a Nifty 50 index fund. And then as you go along and get some experience, you could also look at mid-cap funds. You could look at a flexi cap fund, which invests in a combination of large cap, mid cap, small caps, and maybe international stocks. That depends on the fund. But you'll get a good exposure to all of these market caps as well through a flexi cap fund. So I think all a woman needs in her portfolio of equity funds, which are easy to invest. You can just, provided you choose them right, you can just remain invested for the long term, would be a Nifty 50 equity fund, index fund, flexi cap fund, and a mid cap fund.
Okay, that's keeping it plain and simple, ladies. You don't have to make it complicated. If you want safe, secure returns, just get into an index fund, perhaps a flexi cap fund, and maybe a mid cap index fund as well. All you're doing is benchmarking to the index, and hence you're sort of riding on the India growth story, as Mrin was saying. Mrin, we need to take a short commercial break, but I'm very interested to know what else should women be doing with their money. So we'll come back in just minutes from now. Stay tuned. Well, thanks for keeping it with CNBC TV18. This is Smart Money, and today we're talking about women and what they should be doing with their money. Mrin Agarwal, who is a financial educator, she's done a lot of work in this space, is joining in. She's been with us through the course of the last 15-20 minutes, and she's been telling us about how a couple of things is what you can do. Perhaps just, play a little safe with target maturity funds on the debt side. On the equity side, you can look at balanced advantage funds, and you can also look at just index funds. All right. You also said, Mrin, before the break that you can look at some flexi cap funds as well. If someone is not interested in, pure index funds. I mean, I may not want exposure to, say, the metal sector or, say, an ailing real estate stock or whatever. If I want to invest in particular mutual funds that are focusing on a theme or a momentum, what are the funds that you would recommend for women right now?
Actually, I typically don't recommend any thematic funds or sector funds. The reason being that they tend to be too concentrated. And, some of these strategies may or may not work out. Plus, what I find is that whatever are the, high conviction ideas and whatever are the trending or, stocks or sectors which are expected to have a good growth would anyway be part of the flexi cap fund. Generally what I find is that when people get into thematic funds or sector funds, what happens is that they find it really difficult to actually track these in the long term and really stay on course. So I don't really recommend them.
So you recommend starting with a Nifty 50 index fund, right? So that's the first approach that you should have. And then what does one do?
Look at mid cap funds, look at flexi cap funds. I would say these are two good categories that are there. Of course, if for the tax saving purposes, you can also look at ELSS funds which are available. But I think just a combination of these couple of funds in your portfolio is good enough.
Any names that you'd want to recommend on the mid-cap side, on the flexi-cap side? Any examples that you'd want to give on what, what are good funds to invest into?
Yeah, I think, specifically on index funds, because I get this question a lot saying that, there are so many fund houses that are available today in the market, and which one do I go with? So I think, the first thing is not only to go with the expense ratio, because a lot of times investors tend to look at index funds only based on the expense ratio. I think what is really important is to look at something known as a tracking error, which is basically talking about taking into account the expense ratio and the agility of the fund manager in actually deploying the monies that are coming in, right? So it's important to look at the tracking ratio over the expense ratio, because you could have a fund with lower expense ratio but a higher tracking error. The tracking error can be found in the fund fact sheets very easily. So do use that to evaluate and then invest accordingly. On the FlexiCap side, so the index funds, two index funds which I like the ICICI Nifty 50 index fund, and I like the HDFC Sensex plan. And two funds that I like on the FlexiCap side, I like Parag Parikh FlexiCap fund and the Kotak FlexiCap. I like Parag Parikh because of the overseas exposure. So you have this one fund that's giving you large cap, mid cap, small cap, and overseas exposure as well. And hence you don't need to look at an international fund separately. And
Okay, I have a
on
question
the
there. I have a question
yeah.
there because Parag Parikh's fund has not done very well, right? Purely because of the exposure it has to the global markets. And as we know, global technology stocks, global banking stocks have been under pressure. What do you do at a time like this? Do you keep the faith?
Yes, you just keep invested. And that's the whole idea in equity investing, that you need to have a 7 to 10 year time frame, because there are going to be short term volatilities. There is not going to be linear growth. And certainly, the only thing that can help you manage volatility is the time, right? Because you cannot impact, how the markets behave is not in your hands.
Okay. Gold has traditionally been held as a security for bad times, right? However, women seem to prefer physical gold over paper gold. We were discussing this a while back. How do you change that mindset? If you'd want to once again reiterate the importance of putting your money into, say, SGBs or ETFs, it's better off than investing in physical gold, what would you tell your women viewers?
Well, every time I go to buy gold, I'm very horrified when I calculate and I see that 30% of the money that I'm paying is going towards charges, making charges, wasted charges, and whatever else is there. And, also when you're selling it, there's a 5 to 10% loss that you have. So, you're basically looking at 30 to 40% as money just going away when you're buying physical gold. And you're going to save all of this if you buy paper gold, right? And that should be reason enough for you to move away from physical gold to paper gold. And also, the whole point about the tangibility of the product doesn't really matter anymore.
But what about the argument that if you're buying physical gold, right, you'd rather buy it in the form of gold coins or in the form of gold biscuits if you can afford it? That's a better way. You can sort of escape making charges. You don't believe in that?
No, because you have storage issues and stuff like that. And I think it's just this whole factor of, this feel-good factor of tangibility that exists.
And this legacy issue, right? What our fathers, forefathers, rather mothers and grandmothers have been doing. We just sort of take it forward. It's time to sort of end that legacy. So all the ladies watching us right now, you're losing a lot of money if you're buying physical gold. If you're interested in gold, rather buy paper gold. I also find that gold schemes from jewelry shops have become suddenly very popular. Any take on that?
Oh, I think you should be very mindful of it. So what typically happens in these schemes is that you invest for a period of 11 months, and then the jeweler puts in the money in the 12th month, and then they allow you to buy gold from that accumulated amount. But typically you have to buy only gold jewelry, and you cannot buy coins and bars. And the other thing is that if you have an emergency and you want to exit from that scheme, you can't, right? So the issue that I have with that scheme is that you're taking the risk of putting your money with one jewelry shop and one jeweler. And, if, essentially what you're doing is that you're providing short-term working capital to the jewelry shop, right? Now, if for whatever reason, business is not good or whatever reason, this person shuts the shop tomorrow, there's no recourse that you have, because as far as I know, that this investment is also shown as an advance purchase and not a deposit, right? So when something is shown as a deposit, then of course there's regulation, there are various guidelines, there's grievance mechanism and all of that. But when it is shown as an advance purchase, as far as I know, there's going to be none of that. So you're going to be at the mercy of the jeweler. So as such, I don't recommend these schemes. I know they're pretty high yielding, and I know a lot of people are attracted towards it because of that. But I don't recommend it simply because of the credit risk that exists with the product.
Okay, that's very important advice. Thanks for that, Mrin. So for short, medium and long-term goals, right, let's get back to that. What are the products that women can consider in their portfolio? You spoke about a couple of them, but if you had to summarize for us, what should a woman's portfolio look like?
So for the short term, which I would say would be below 3 years, you can look at fixed deposits. They're easy, simple to invest, and of course, they're going to be fully taxable. But I think you have some great rates available as well right now. So look at fixed deposits. Of course, you can look at ultra short duration debt funds as well. But if you find it difficult to figure out what this product is, just go with a fixed deposit. On the medium term side, which I would say would be between 5 to 8 years, you can look at the sovereign gold bond, of course. If you prefer gold as an investment, you can, of course, look at debt funds also. You can look at, for example, you could look at short duration debt funds, which I've always preferred over any other category in debt funds, because I have found the risk adjusted returns on these funds to be more consistent than any of the other categories. And the third one that I spoke about, of course, was the balanced advantage funds that you can look at. The fourth one, of course, part of the debt space is also the target maturity fund. So you've got sovereign gold bond, you've got target maturity fund, you've got short duration debt funds, and you've got the balanced advantage fund in the medium term space. In the long term, which is, let's say you're looking at really, really long term periods above 15 years, of course, equity funds can be looked at for any period above 7 to 8 years. But in the long term, certainly you need to have a good allocation to equity funds. I talked about the categories already. Another product that I really like from a retirement perspective is the National Pension Scheme. Again, in the National Pension Scheme, you have various investment options that are available. And the one that I like the most is the active equity choice, because it allows you to build a large retirement corpus. So certainly look at the National Pension Scheme as well. It's very low cost, very disciplined investing, because it matures at the age of 60. So these would be net the products that I would suggest: fixed deposits, mutual funds, and sovereign gold and NPS.
Okay, that was very, very helpful, Mrin. 360-degree perspective on what you should be doing with your portfolio. And you know what? It's not just for women, right? It's for all the men and women out there who have not taken charge of their life. Remember, financial independence is a superpower, and we are here to help you achieve that. Of course, the occasion today is of Women's Day, so we're talking about women. But this is to everyone who hasn't taken charge of their finances. This is how you got to do it. Mrin, thanks a lot for joining in. Appreciate your thoughts. Well, with that, it is curtains down on another special edition of Smart Money. Thanks for watching.